Hello, welcome to Accounting Hub. I'm Professor George Scarpin, PhD in accounting, and our topic today is accounting for long-term contract overall loss. One of the hardest topics of revenue recognition and long-term contract, we have three possible scenarios: profitable contract, contract with periodic losses, and contract with overall loss. So we have three videos, and the other two videos, they are in our video description. So here we have the 5 steps to revenue recognition. Identify the contract, no problem at all. Identify performance obligation. Usually here we talk about single performance when we talk about long-term contract. Usually it's construction. So I will construct an office building. This is my performance obligation. Transaction price. Usually we have it in the contract. Allocate transaction price. No allocation required here. And the hardest one, number 5. Recognize revenue when each performance obligation is satisfied. And we have it at a point in time at the end of our contract or over a period of time. So here, that is where we can do that. And when we have losses, we worry about 2 types of contract losses. Periodic loss, our previous video about that, it is in our video description, and overall loss, project to occur for the entire project. Sellers must update their estimates and recognize losses as necessary, but the specifics depend on the timing of revenue recognition. So before the thank you, let's go to our Excel file. And by the way, all our Excel files, they are free to download, and the link is in our video description. And this Excel file here, we have profit contract, partial loss, and entire loss. So it is the same Excel file for all of our videos. So here, let's delete these ones here. And yes, so here we are. And what do we have here? Whoa, 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 whoa. So let's delete it here. We have some given numbers. So we have these costs incurred during the year. 3 millions and 3/4 for 2018, 3.1 million for 2019, almost 6 million for 2020. And the contract price, $12.5 million. Billing, that is our cash flow, 3 million, 5 million, and 4.5 million. So let's focus the first one based on the entire loss when we record it only at the end of our contract. So let's delete it here, delete it there, delete it, delete it, delete it. So construction in progress, that is our costs. So here we have our costs. Okay. And then the credit here is cash or anything payable. Accounts payable, notes payable, whatever payable. Billing, and it is an asset, just like inventory or any other assets being constructed. And the billings, that is our cash flow. 3 million, $5 million, and $4.5 million. And here the debit is cash or anything receivable. So here we have these numbers, no revenue, no expense yet. So let's do it. The revenue from long-term contract. The revenue is our price. The price is our contract price. So here we are recording it only at the end of our contract. So 12.5. However, here we have a problem. So this is the total costs and the estimating remaining cost. So at the end of the first year, our estimated cost would be $9.3 million. Our contract price, 12.5, profitable contract, no problem. The second year, we have a loss in our contract here. So 12.5 is our estimated number against 12.5 the contract price. So here it doesn't matter if we are talking about when we recognize our revenue. We need to record this loss here because it is a permanent loss. It is not just like here that we have profitable, 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 but on 2019, when we compare here, we have a loss on 2019 because our revenue 2.4 million, our cost 3.1. However, the contract is profitable. Here, no, we have a loss in our contract. So what do we do here? We recognize this loss. How much is the loss? 12.7 less 12.5. So we have a loss here, 259. And then the credit is our construction in progress. And by the way, this billings here, sorry, it is a liability just like deferred revenue. So in our balance sheet in 2018 and 2019, 2018 construction in progress greater than billings. So billings will be a contract count of construction in progress. 2018 and 2019 combined, billings is greater than construction in progress. Then it flips. Construction in progress is the contract out of billings. Okay, so here we are. The cost of construction here. Our cost of construction is 12.8. However, less the 259. So our cost will be 12.6 because these two numbers combined, then we have the total here. Okay? And we need to close this journal entry here because 2020, our contract is over. So we have no more construction in progress, no more billings. So let's sum it. 12.5, and then we need a credit 12.5 here. However, we have a problem. It is not balanced. We need a credit here. What is our problem? This journal entry here, this is the problem. The cost of construction, 12.6, revenue, 12.5. Debits are greater than credits, so we need a credit. So we need a credit here. Cost of construction less revenue, 120. Now we have the same number, so we have it closed. And then how much is the gross? Instead of gross profit, we have here the gross loss. It will be revenue less cost less the loss in 2019. So our total loss will be 380. Let's see, that matches with this difference here. So 380. So this is quite different from the other two long-term contracts, profitable or partial loss. However, this is not so good info because we don't have gain and losses every year. We don't have the info in 2018 when we were profitable. We have only the losses. Another way to do that, when we record it upon completion. And then let's delete it here, and then let's go. What changes? Or what doesn't change? First, construction in progress, it is again our costs. It doesn't change. It doesn't matter what kind of contract are we working with. So here we have our 2.12.8. Our billings, exactly the same as our billings here. So for revenue recognition, the billing is completely useless. Okay? And the cost of construction here, it will be the same as our cost here. And the last one here. What do we need here? We need the revenue. And how do we find the revenue? We need to find the percentage of completion. So actual costs, total actual cost, 3.3 and a quarter, but 3/4, sorry. Total costs, 9.3. So the percentage of completion, actual cost divided by total cost, 40%. If we have 40% of our contract completed, we will record 40% of our revenue. So contract price times 40%. Let's do this formula here for all our remaining years. Whoops, we have a problem here. Let's do it again. Okay. At the end of the third year, will always be 100%. Okay. However, these numbers, they are cumulative. So we have the cumulative revenue. However, I cannot record cumulative numbers on revenue. I need to split it. So what do we have here? Revenue recognizing prior periods. First year, nothing, because this is the first year. Second year, 2018, 5 million. Third year, 2019, 6.7 million. So the revenue in the current period will be cumulative less revenue recognized in prior periods. 5 million first year, 1.7 and 5.7. Another way to find it is completion at the end of the second year, 54. Completion at the end of first year, 40. So our completion here will be 14.08. So our revenue for the second year, 12.5 times 14.08. So here we have the same numbers. So this is our revenue. So let's do it. Revenue, $5 million, 1.7, and 5.4. However, these journal entries here, they are not balanced. So we balance them on construction in progress. So the first one, we have more credits than debits. So we need a debit here. 5 million less 3 millions and a quarter. So the first year is our gross profit. We have profit here. Second year, we have a loss. Why? Because our debit greater than our credits. So our gross loss will be debit less our credits. Will be 1.4, almost 1.4 million. Let's work with the orange one, orange one, orange one. And the last year, again, debit greater than credit. So we have a loss here. Debit less credit. So 239. Let's fill it with a red here, red here, red here. And what do we have here? Gross profit 380. 380. It matches. Very good. However, we need to close these two T accounts here. Let's do the same here. Our debit will be the sum of our numbers here. So we need a credit. We need a credit here. close it, close it, we're good. So when we are talking about percentage of completion, is the same method for all of our three contracts: profitable, partial loss, and overall loss. Okay, guys, so thank you so much. Subscribe our channel. You will be the first one to know when a new video arrives. Like our Facebook page, Accounting Hub by Dr. Scarpin. If you have questions or comments, leave it here or email me at jscarpin@gmail.com. Have a very nice day, guys, and God bless you.